$4,800. That's roughly what the IRS quietly takes from the average retiree every year through one specific mistake. Most never get it back. They don't know to ask. In the next 12 minutes, I'll show you the exact form that fixes it, the magic sentence to use when you call, and the deadline most retirees blow without realizing. When you were working, your tax was handled in the background by your employer. Every paycheck, the right amount went out. You never thought about it. The day you stopped working, that system stopped. Nobody sent you the replacement instructions. The IRS doesn't call. They don't write. They wait for you to figure it out, and most retirees never do. So here's what happens. Your pension keeps using the old W-4 form from years ago. Social Security holds back zero by default. Your retirement accounts assume the same withholding you set up when you were 35. Every month, the numbers drift further from reality. The result: most retirees overpay by hundreds every month, or they underpay and walk into a five-figure surprise bill in April. Today we fix that. 5 specific moves, real form numbers, the exact words to say on the phone. Let's go. Move 1. Tell the IRS you've retired. Sounds obvious. The IRS does not automatically know your status changed. Your pension provider doesn't tell them. Social Security doesn't tell them. They wait for paperwork. The form is called W-4P, Withholding Certificate for Periodic Pension or Annuity Payments. 1 page, free, available on IRS Gov. Take Margaret. Margaret retired 3 years ago, 68 years old, retired teacher in Florida. She filed her original W-4 the day she started teaching in 1979 and never touched it again. Every year of retirement, her pension provider held back 14% based on a 40-year-old form. Her actual tax bracket, 11%. Difference, $1,200 a year. Over 3 years, $3,600. She got it back. She filed the W-4P, then filed amended returns going back 3 years. The window for amending past returns is 3 years from the original filing date. Miss that window, the money stays with the government. The magic sentence to use when you call the IRS at 1-800-829-1040. Quote, "I've recently retired. I want to update my Form W-4P so my pension withholding reflects my actual retirement income." End quote. That's it. They walk you through it. They have to. The deadline matters. File before your next pension payment cycle, or the over-withholding continues for another full month. Move 2. Recalculate your withholding from scratch. Your old W-4 assumed your salary was your only income. In retirement, you have 3 or 4 income streams: pension, Social Security, IRA distributions, maybe a part-time job, maybe rental income. The IRS has a free tool called the Tax Withholding Estimator. Go to IRS Gov, search those 3 words, enter every income source, enter your filing status. The tool tells you the exact percentage your pension should withhold. A chap I sat with last year, call him Roger, 66, engineer, retired from Boeing. His pension was withholding 22%. Roger also had Social Security and a part-time consulting gig. The estimator showed his actual federal liability, 14%. He was overpaying $800 a month, nearly $10,000 a year. The fix took 15 minutes. New W-4P submitted, withholding adjusted. The money started flowing back into his account on the next payment. The magic sentence for your pension provider, your former employer's benefits office, or the company managing your annuity. Quote, "I'd like to update my federal withholding using a new W-4P. Please process it before my next payment date." End quote. Most providers handle it within 10 business days. Some do it same day. Watch the underpayment trap. If you cut withholding too far, the IRS hits you with a quarterly underpayment penalty. The safe harbor rule says you need to pay either 90% of this year's tax or 100% of last year's tax, whichever is lower. Match that number, you're protected from penalties even if you owe at year-end. Move 3. The Social Security Tax Torpedo. This one catches almost everyone. Most retirees believe Social Security is tax-free. It is, up to a point. The moment your combined income crosses $32,000 for a married couple or $25,000 for a single filer, the IRS starts taxing your Social Security. The maximum, 85% of your benefits become taxable income. The torpedo. One extra dollar of IRA withdrawal can push you into the taxable zone. That dollar gets taxed. Plus, 85 cents of Social Security becomes taxable. Plus, your Medicare premiums can jump 2 brackets. Effective marginal tax rate on that single dollar, over 40%. Take Eileen, 67, widow in Ohio, took a one-time IRA withdrawal of $15,000 to replace her furnace. Her tax bill that year jumped $6,400. Not because $15,000 got taxed at 43%, because the withdrawal triggered Social Security taxation, raised her Medicare premium tier, and pushed her into a higher bracket all at once. The fix: spread distributions across years. Use Roth conversions in low-income years. If you're under 73, every year you don't pull from the IRA is a year you control the timing. The magic sentence for your tax preparer. Quote, can you run a Social Security taxation projection on any IRA withdrawal I'm planning? End quote. If they don't know how, find a preparer who does. Move 4. The credit nobody tells you about. The IRS Retirement Savings Contributions Credit, also called the Saver's Credit. If your adjusted gross income falls below $76,000 for married couples or $38,000 for single filers, and you contributed to an IRA or 401k that year, including catch-up contributions if you're over 50, the IRS gives you a tax credit of up to $1,000. $2,000 for couples, a credit, not a deduction. Dollar for dollar off your tax bill. Take Margaret again, the same Margaret from Move 1. After updating her W-4P, her adjusted gross income dropped below the threshold. She had been contributing to a Roth IRA from her substitute teaching income, $3,000 a year. The Savers credit gave her $200 back. Small number, but she'd never claimed it. The form is Form 8880, 1 page, 10 minutes. Across 3 years of unclaimed credits, Margaret recovered $600 she never knew she was owed. The magic sentence for your tax preparer. Quote, did you check whether I qualify for the Savers credit on Form 8880? End quote. If they say no, ask why. If they don't know what it is, switch preparers. Move 5. The 4 dates you can't miss. If your withholding doesn't cover your full tax bill, and for most retirees it won't, you owe quarterly estimated payments. 4 dates: April 15th, June 15th, September 15th, January 15th of the following year. Miss a date by 1 day, the IRS charges interest from that day forward. Miss enough dates, they assess an underpayment penalty on top of the interest. The fix is automation. Most pension providers and brokerages let you set up automatic quarterly transfers to the IRS. Set it once, done forever. The exact amount to send. Take last year's total federal tax bill, divide by 4, that's your safe harbor quarterly payment. As long as you pay at least that, you're protected from penalties no matter what your final bill looks like. Form 1040 ES. Mail it with your check or pay online at irs.gov/payments. Both work. Online is faster. The IRS confirms receipt the same day. You've worked decades for this money. Don't let an outdated form quietly drain it for years. 5 moves. File the W-4P. Recalculate using the IRS Estimator. Watch the Social Security torpedo. Claim the Savers credit. Lock in the 4 quarterly dates. If even one of these saved you $1, the subscribe button keeps the next one coming. New videos every Tuesday and Friday. In the comments, tell me which of the 5 you didn't know about. I read everyone. I'll see you in the next one.